Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money-making world, and sometimes that means digging into a big old pile of paperwork to find the juicy bits. Today though, we're talking about Johnson Mutual Funds Trust, and let me tell you there are some interesting money movements and a big announcement in this filing. Stick around because by the end of this, you'll know exactly what's up with Johnson's funds over the last 6 months. And hey, if you like getting these corporate insights without all the jargon, make sure you subscribe and join our Discord community linked in the description. So what exactly are we looking at here? Well, this is an amended report, a way for Johnson Mutual Funds Trust to go back and fix something in their last filing. They originally filed a report for the period ending June 30, 2025, and now they're filing an amendment because of a formatting issue. Apparently, the alignment of values on their statements of assets and liabilities for two specific funds, Johnson Core Plus Bond Fund and Johnson Municipal Income Fund, got a bit messy, like a room after a toddler visits. The main point is they're fixing a typo or a glitch that put their investment securities in the wrong column. Nothing major financially, but good to know. They're cleaning things up like a boss. Hunt Fund and Johnson Municipal Income Fund got a bit messy, like a room after a toddler visits. The main point is they're fixing a typo or a glitch that put their investment securities in the wrong column. Nothing major financially, but good to know. They're cleaning things up like a boss. Alright, so the big picture is Johnson Mutual Funds Trust is this group of investment companies. They've got a bunch of different funds, each with its own goal. We're going to look at a few of them to see how they've been doing, but first let's glance at the overall setup. It's a standard SEC filing, so you see all the usual details, like who's in charge, where they're located, and their phone number. Boring for us, but essential for the SEC. This file number is like their social security number for the SEC. It's how they keep track of all these financial companies. The important thing is that this filing is an amendment to a previous report. They're essentially saying, hey, we messed up a little bit on a previous filing and we want to correct it. It's like going back to fix a typo in an essay. Let's dive into the actual performance of some of these funds because that's where the real story is. First up, the Johnson Equity Income Fund Class I. For the period from January to June 2025, this fund saw its net assets grow to a whopping 680,500 index. It's benchmarked the S&P 500 index. It actually underperformed. The report mentions that strong first quarter performance was eroded in the second quarter, specifically after an announcement on April 9th about a pause on US reciprocal tariffs. This pause led to a rally in markets, especially in big tech stocks. The fund management points out that both their sector allocation and stock selection contributed to this underperformance. They were underweight in communication services and technology, which were the outperformers post-tariff pause, and overweight in healthcare also didn't help. On the bright side, though, they benefited from being overweight in industrials, which was the top performing sector this year. The report also highlights the concentration of the S&P 500 with giants like Nvidia and Meta being major detractors because the fund didn't own them. This shows how important owning the right big stocks is in a market like this. And how is it done over the long haul? Let's look at a 10-year performance. If you invested $1 million back in June 2015 in the Johnson Equity Income Fund Class I, you'd have about $2.9 million by June 2025. That sounds pretty great, doesn't it? But the S&P 500 index on the same investment would have grown to about $3.6 million. So while the fund made you over $1.9 million, it lagged the S&P 500 by about $70,000 the long haul. Let's look at a 10-year performance. If you dollarify them, that sounds pretty great, doesn't it? But the S&P 500 by about $70,000. That's a significant difference. Looking at average annual returns over the last decade, the Johnson Equity Income Fund Class I brought in 11.39%. The S&P 500 index, however, delivered 13.65%. So over the long term, the index fund has been a better bet for growth. The asset weighting shows that 97.6% of the fund is in common stocks and the rest in money market funds. Their sector weighting is quite diversified, but notice the big chunk in technology at 23.6% and financials at 17.7%. This is followed by industrials 13.6% and healthcare 11.9%. Their top holdings are pretty much the biggest names in tech and finance. Microsoft, Amazon, and Apple are all there. This mix explains why they might have lagged the S&P 500 when those mega cap tech stocks took off. Now, for the Johnson Opportunity Fund Class I, this one's focused on long-term growth. Total net assets are around $178 million. For the first half of 2025, it registered a small net return of negative 0.23%. The report says trade policy uncertainty fueled market volatility, but a strong rally from April erased early on in Miel Bali 0.23%. The report says trade policy uncertainty fueled market volatility, but a strong rally from April erased earlier losses with tech and cyclical growth. Leading the way, here the fund has a more spread out approach. Technology is still a big slice at 22.3%, followed by industrials at 18% and financials at 12.4%. What's interesting is the materials sector at 10.8%. That's a significant weighting and shows a different strategy compared to the equity income fund. Their top holdings mention American Financial Group, Reliance Inc. and Bentley Systems. These are not as well known as the tech giants, but could be the fund's bet on finding hidden gems. Let's switch gears to global markets with the Johnson International Fund. This fund has $21.5 million in net assets and is focused on international stocks. For the first half of 2025, it returned 11.98% over 1 year. However, over 5 and 10 years, it's been at around 10.3% and 5.48% respectively. The benchmark MSCI THUBAL ex-USF respectively, the benchmark MSCI TUL ex-USF respectively. The benchmark MSCI ACW ex-USF index has performed better over the 1 and 10 year periods. A notable update here is a future liquidation of this fund expected in the fourth quarter of 2025. This happens sometimes probably because it's not as popular or profitable as they'd hoped. So if you're invested here, it's time to make a move. Looking at their country breakdown, Japan is their biggest bet at 15.2%, followed by Canada at 7.9%, and France and Germany both around 7.5%. This is a global diversified approach. The top holdings are mostly ADIA's American depository receipts of large international companies like Iberdrola and Sony. Next, the Johnson Enhanced Return Fund. This one aims to beat the S&P 500. Over the last year, it returned 15.38%, which is slightly better than the S&P 500's 15.16%. Over 5 and 10 years, it's also generally performed well. This fund is a bit different. It's heavily invested in fixed income with 64.5% in corporate bonds and 18.7% in US Treasury obligations. It also has 12% in collateralized mortgage obligations. This hybrid approach is likely how it tries to achieve its enhanced return goal by potentially balancing equity market risk with bond market stability. For bond funds, let's look at the Johnson Institutional Core Bond Fund Class I. This fund has a massive $1.8 billion in net assets. Over the last year, it returned 6.47%, beating the Bloomberg US Aggregate Bond Index. However, over 5 years, it actually slightly underperformed at negative 0.96% compared to the benchmark's negative 0.73%. This shows how bond market performance can be tricky year to year. This fund is almost entirely in fixed income with 46.1% in corporate bonds and 26.8% in collateralized mortgage obligations. Treasury obligations make up another 23.9%. Their top holdings are US Treasury bonds with very specific maturity dates and coupon rates. This is typical for a core bond fund aiming for steady income. And finally, the Johnson Core Plus Bond Fund. This fund has $49 million in net assets. Over the last year, it returned 6.46%, slightly beating its benchmark, the Bloomberg US Aggregate Bond Index. But since its inception in late 2021, it's slightly underperformed. The fund beat its benchmark for the first half of 2025. The report mentions duration and an overweight corporate bonds as key drivers. They also allocated to high-quality, high-yield offerings which likely boosted returns. Interestingly, they used Treasury futures for exposure to the long end of the yield curve, a more complex strategy. Let's touch on the Johnson Municipal Income Fund. This fund is all about tax-free income. It has $175 million in net assets. Over the last year, it brought in a modest 0.39% return, slightly behind its benchmark. Over the last decade, it's returned 1.41% annually. This fund is for those seeking tax advantages rather than high growth. The fund is heavily invested in high-quality municipal bonds with 57.7% rated AA and 24.3% rated A. Only 6.1% is in BBB rated bonds, showing a conservative approach. Noteworthy is that 68.6% of their holdings are from Ohio, which makes sense as a municipal bond fund often focuses on its home state to maximize tax advantages. Now, this filing is an amendment, so the main story isn't a massive strategic shift, but rather a correction. It's like finding a small error in a big financial report and fixing it. The fact that they're amending it shows they're diligent about accurate reporting. None of the underlying financial data or strategies in the original report would have changed, just some formatting. So what's the takeaway for Johnson Mutual Funds Trust? They're managing a diverse set of funds with varying performance. Some are trailing their benchmarks over the long term, like the Equity Income Fund and Municipal Income Fund, holding their own or slightly outperforming the international funds liquidation looming is a clear signal that not all strategies work out. For the bond funds, they seem to be doing an okay job of keeping pace or slightly outperforming their benchmarks. It's a mixed bag, but that's common in the fund world. They're careful about their reporting, which is a good sign of transparency. What do you think about these numbers? Are you invested in any of these Johnson funds? Let us know your thoughts in the comments below. If you found this breakdown helpful, give us a like and subscribe for more corporate deep dives. And join our Discord if you want to chat more about these topics. Thanks for watching, and we'll see you in the next video.